Hey, what's up, my friend? So let me ask you a question. Have you ever, seen the price come into support and think, oh, this is a strong level of support, it's gonna hold, so you buy. The next thing you know, the price smashed through support and you got stopped out. Or how about the price came into an area of support and then he made a huge rally away from it, a huge bullish move. But the problem is you got stopped out of your trade before you can even take part in the move. So has any of those happened to you before? Because if it's a yes, right, then today's training is for you because I'm going to share with you what are some of the most common mistakes, right, traders make when trading support resistance and how you can avoid it. But first, if you're watching this video for the first time, right, hit the thumbs up button and subscribe to my YouTube channel. The link is below. Just hit subscribe and the thumbs up button. This way, whenever I publish a new training, you'll always be updated. Sounds good? Then let's get started. First thing first, right, the more times support is tested, the stronger it becomes. Have you heard of that saying before, from textbook or forums? You see stuff like, oh, the more times support is tested, the stronger it becomes. Well, that's not true, right? The truth is this, right? Is that the more times support gets tested within a short period of time, the weaker it becomes. And let me explain why. So let me just give you an illustration. So let's say, right, let me just get rid of this fugly lines. Okay. So let's say this is an area of support. Let's say this is an area of support, right? And the price goes up, comes down, and test it multiple times. So you can see that, support is an area where potential buying pressure would come in. So let's say there is a certain limit order to buy at support, maybe from a hedge fund or institution, whatever. Let's say, it's worth $100 million worth of buy orders. First time it comes up, right? It fills up maybe, let's say, 50 million. Okay. Then it rallies, comes back down, it fills up the remaining, let's say, 30 million. Okay, then it rallies, comes back up, fill up 10 million, comes back down, fills up the remaining 10 million. Okay, then eventually there's no one left to buy, the price breaks down. So you can see that the more times price, right, retest support within a short period of time, the more of these buy limit orders get filled, or the more these buy orders get filled. And once all these buy orders get filled, who's left to buy? Me? No, I don't want to be buying. So that's where you get, right, the more times price retest support within a short period of time, the likelihood it will break down. So this looks something like a descending triangle, okay? And the opposite, right, is the ascending triangle. Let me just share with you an example, right? So over here, you can see Bitcoin that illustrate this concepts pretty well. So you can see that there's a support around the 6,000 level, okay? Price came into support, rallied once, came back down, rallied, came back down, rally, came back down, slight rally, and then it breaks down. So you can look at this, right, that just by looking at this price action, you know that this market is getting weak, right? If you just look at the so-called swing of the rally, right? The first time is pretty strong, right? Nice big bullish candle. Second time, still strong, but not quite as strong as the first time. The third time, you get weaker, and the fourth time is really, really weak, right? All the small range candles. So this is a sign to you that, the buyers, they have difficulty pushing the price up higher. And this, right, to me, is a sign of weakness, not a sign of strength. So whenever you see, right, the more time support is being tested within a short period of time, that's a sign of weakness. And moving on, right, you can see another example over here. This is the opposite, right? You can see that over here, again, this is resistance. Price approach resistance, sold off, approach resistance, sold off, approach resistance, and then sold off a little bit. So now you have a series of higher lows into resistance. So is this a sign of strength or weakness? This is a sign of strength, right? It shows you that the buyers are willing to buy at these higher prices, and the sellers, they have difficulty pushing the price lower. First time they push the price, pretty strongly towards the downside here as well. Then after which the subsequent selling pressure from the sellers, it got weaker and weaker, right? It got weaker over here. So this is to me a sign of strength, right, from the buyers. They're willing to buy at this higher prices. Okay, then we lead to a breakout. Okay, let's see if I can find another example. Okay, so this is another one, Bitcoin again. You can see again, right, series of lower highs coming to support. This to me is a sign of weakness, right, that the market is about to break down lower. So let me just see if I can find another example to illustrate this concept. This concept is important. Okay, so another one over here, you can see this one. Not as clean as the Bitcoin example, but still you can see a series of lower highs coming into support. Okay, lower highs coming into support, again, it's a sign of weakness. The market is weak and is likely to break down. Okay, so the key thing here is, again, right, higher lows into resistance is a sign of strength, and lower highs into support is a sign of weakness. Number two, right, setting your stops below support, right? So here's the thing, right? When you set your stops, let's say just below support or above resistance, it makes it easy for you to get stop hunted. What do I mean by that? So let me ask you this question, right? So let's say the market is in a range, right? And it comes into support. Before it rallies off, it spikes down lower, then it goes up higher. So when you buy at support, right, on the brief rally over here, you set your stops below this low or below this low, you get stopped out by this spike down lower. Have it happened to you? Or how about this, right? Market could be trending. Let's say the market is trending. Market is trending like this, okay? Then market breaks below this, let's say market goes down, then it breaks below this swing low. So you thought there's a break of swing low, there's a breakdown, you go short. And where do you put your stop loss? Well, you put your stop loss just above this swing high. And what does the market do? It comes up to the swing high and then collapses lower. And then you get stopped out again. Familiar? So this is the mistake to avoid, right? You don't want to be putting your stop loss just below support or above resistance. You want to set it a distance away from support resistance to avoid this type of, stop hunting that goes on. So let me just give you an example, right? So if you look at this one over here, New Zealand yen. Here, okay, so you can see that this is the example that I just shared with, right? So you can see over here, right? Oh, price, it looks bearish. Okay, market looks bearish, right? Breakdown of this swing low, right? This is a trend continuation trade. You have a series of lower highs and lower lows. Market is in a downtrend. Let me go short. Where do you put your stop loss? You put your stop loss just above this swing high, right? After all, this is where the highs shouldn't get invalidated, because if the price breaks above the swing high, the downtrend is over. So that's why you put your stop loss at this swing high. Then what happens? Well, the market, right, somehow knows what you're doing, right? It hits your stop loss above this highs, swing it a second time, right? So you can see it swings at it twice, right? Once and twice before it finally reverses towards the downside. Okay, so you can see this phenomenon happening again right now. Price, right, heading down lower, then it swings up, take out the highs, comes back down, swings it a third time before right now possibly heading down lower finally. So you can see that traders who set their stops just above resistance, right, they are going to get stopped out. Okay, so this is important. Right? Don't set your stops right just below support or above resistance. Let me give you another example. This one over here on oil. This is the lows on oil. Price came down all the way towards these lows, spiked through the lows before it rallies up higher again. So here's what happened, right? Price, right, on this oil, it came down all the way down below these lows of support before it did a false break and rally up higher again. So you can see that again, right? Traders who set their stop loss below this low got stopped out over here. And then this phenomenon happened again, right? Traders again, who set their stops above these highs, right? Maybe they saw the price head up higher, start to reverse, have their stop loss above this highs, or maybe even above this highs. Well, market spike up all the way and then reverse. So again, setting your stops above this highs and this highs, right, would likely have gotten you stopped out of the trade as well before the market could even move in your favor. So now the question is, how do you set your stop loss, right, in such a way that, it prevents this type of stop hunting from happening to you? So here's my suggestion, right? Let me just give you an example. Let's go with just the New Zealand yen. So let's say New Zealand yen, okay? Right now the price is at this area of resistance, right? You know that you don't want to just set your stops above the highs. You might get stopped out on a spike. What you want to do is use the ATR indicator to help you add a buffer to your stop loss. Okay, average to range. I typically go with 20 period ATR. And I use the SMA. Not that it makes much of a difference, it's just my preference. And you can see that right now, one ATR is worth about 60 pips. So what you want to do is to find out what's the highs over here, and you add on 60 pips. That's it. Okay, so let's say the highs is currently, let's say, the $70, right? So your stop loss will be at $70.60. That is your stop loss, right? You give it a 1 ATR buffer over here. And the 1 ATR buffer can be, found out using the ATR indicator. Okay, so that's how you would go about setting your stop loss. So if that's the case, right, your stop loss would now be somewhere about here. Okay, let me just change this to red color. So this means, right, even if the price, let's say, even if the price were to spike up higher and come back down, you will still likely be in the trade because your stops, right, is now away from support resistance. It's away from this market structure where it's prone to stop hunting. Make sense? Okay. Now, moving on, right, another mistake that traders make, right, is that they buy a chop move into support. What do I mean by this, a chop move? So here's the thing, right? Whenever you trade support resistance, right, you want to be buying, right, when there is little obstacles in your way. So for example, if you look at this, price goes up, comes down, comes back down to support. This is the type of price action that you want to be buying when there is just one nice clean move into support. Right, this to me is ideal because the nearest obstacle in your way is possibly at this area of resistance over here. So your profit potential is pretty decent, right, from here to here. Let's call it your profit target, right? It's pretty decent. Now, there are times, right, where you don't get a nice clean move into support. Sometimes you might have something like this, which is very common. Sometimes you might get something like this. Price forms a choppy move into support. Now, if you were to be buying at this support, right, where is the nearest obstacle? Ask yourself. If you look at this chart, the nearest obstacle is now possibly at this swing high over here. So this greatly reduces your profit potential. Now your profit potential, right, is only this portion here because there's all these lower highs, right, that is in your way, where potential selling pressure could be lurking around. So let me just give you an example again. So if you look at this this chart of dollar against the Indian rupee. So this is an example of a setup that I don't want to be buying. Let's say, this you can see is an area of support, right? If I were to be buying right now, the price, right, will be coming shortly into this swing high over here. And that is an obstacle in my way, right? I would very much prefer a nice clean move into support, right? So my profit potential is much more. Okay, so another example you can see over here again, right? You don't want to be buying at this highs because over here is just this swing high where selling pressure could be lurking around to move the market against you, right? To push the price against you. So again, you don't want to be buying, right, when the price is near obstacles, when it's, just in front of, for example, in front of resistance, and you don't want to be shorting, right, just ahead of support. So how should you, trade this, right? So the way I do it, right, is that I like to see a nice clean power move into a level. So for example, this is what I call a nice clean power move, right? So you can see the market just came down so strongly into a level. So I know that if I were to be buying, let's say on the break of the reversal of this candle, the nearest obstacle in my way is at least at this swing high over here. So there's a distance, right, for the price to move in my favor before it faces an obstacle. Make sense? Okay, so let me see if I can get you another example. Another one is a pound dollar as well. If you look at this reversal, the nearest obstacle in my way is at this swing low over here. So there's a distance, right, where the price can move, right, where there isn't any opposing pressure to come in and push the price against me. So this is what I mean by I look for a clean move into a level. Usually when there's a clean move, there's a power move into a level, right, the reversal is more swift. That's why I hate, right, trading choppy move into a level as explained earlier. Okay, so that's the third thing that I have for you, right? Don't buy a chop move into support or resistance. There's too many obstacles in your way. It reduces your profit potential, and there's a lot of levels, right, or areas of your chart where the opposing pressure could come in and just twist the direction of the trade for you. And finally, the fourth mistake, right, is that traders, they treat support resistance as lines on your chart. And here's the thing: support resistance, they are not lines on your chart. Even though you saw that I draw them as lines, but I treat them as an area. Why is that? And the reason is simple, right? There are mainly, two groups of traders out there. One is, we call it the FOMO traders, the fear of missing out traders. So for example, whenever the price briefly touch into support or just come into an area of support, they'll quickly want to buy. They don't want to miss the move, right? So this is the traders who have the fear of missing out. They'll buy as soon as possible when price reaches support. And then you have another group of traders called the cheapo traders. These are the group of traders that want to get in at the best possible price, at the absolute lows of support, at the absolute highs of resistance. That's where they want to enter the trade. So when you have these two group of traders, right, that's where, support becomes an area on your chart. This is where, FOMO traders wants to enter right near the highs of support, and cheapo traders wants to enter at the lows of support. So when you mash these two group of traders together, support becomes an area on your chart. Okay? And one way, right, you can go about treating it as an area on your chart is to draw it as an area. So in this case, right, what I could do if I want to is I could draw support and resistance as areas on my chart. So you can see I can use the rectangle tool. In this case, I can draw it like this. So now you see, this becomes an area. Something like this. Okay, let me just do another example. So in the case of New Zealand dollar, again, I could just do like this. Okay, or how about the New Zealand yen one? The one where we saw there's a lot of stop hunting going on. Could even do it like this. So this is how you can treat support and resistance as area on your chart. So this means, right, let's say we just do for this lower one as well. Okay, so this means if the price, right, when it comes down lower and it touches here, you know that, man, price is at an area of support, right? You want to be alert to potential buying opportunities. At the same time, at the back of your head, right, you also know that this is an area the price could come in deeper into support, possibly even to these lows before it reverts. So now once you look at it as an area on your chart, not a line on your chart, right, you have all this plan A, B, and C at the back of your head, right, knowing what to do, right, if the market starts to show sign of reversal, just because you treat it as an area on your chart, not a line. Okay, so this is important, right? If you're always struggling, right, to identify your support resistance level, treat it as an area, use the rectangle tool I just shared with you, right, and I believe, right, it will help you spot your support resistance areas better. So with that said, here's a quick recap, right? The more time support resistance is tested within a short period of time, the weaker it becomes. Number 2, don't set your stop loss just below support or above resistance. It is prone to stop hunting, as what I've just shared with you. Number 3, don't buy a chop move into support because that reduces your profit potential. There's too many obstacles in your way. And finally, don't treat support resistance as lines on your chart. It's an area, right? Repeat after me. It's an area, okay? So with that said, if you want to learn more about what I do, more about my trading strategy and methodology, what you can do is go down to my website, tradingwithrayner.com. The link is above here. Then just scroll down a little bit, right? I got a couple of trading guides for you, but the one that's relevant to what we have covered today is the ultimate guide to price action trading, right? You learn how to better time your entries and exits, right? We talk about support resistance, candlestick patterns, and much more. So click this orange button and I'll send it to your email address for free. So with that said, I've come towards the end of today's video. Enjoyed it? Hit the thumbs up button and subscribe to my YouTube channel. I will talk to you soon.